Welcome, everyone. I'm Kara Griffith, the President and CEO of Tax Analysts. Thank you for joining us today to discuss the potential tax policy changes that may be in order for pass-through businesses as part of this year's debate over the expiring provisions of the 2017 Tax Cuts and Jobs Act. Today's event is another in Tax Analysts' series of public discussion, Taxing Issues. We launched this series to encourage debate on tax issues, and there will be a lot to debate this year. We'll continue to bring the tax community together with leading policymakers and experts for bipartisan discussions on the future of tax policy and administration. As always, we welcome your feedback on how we can make our webinars more useful, as well as your suggestions on future webinar topics. You can send your feedback and suggestions to events@taxanalyst.org. We also welcome your questions for today's event. Please use the chat feature to submit questions during the webinar. I will begin by asking the panelists a few questions before turning to questions from you, and I promise to get to as many of them as time permits. For those of you who would like CPE credit today, please be sure to participate in the program for at least 50 minutes and answer at least 3 of the poll questions that will appear throughout the webinar. They will appear on the right side of the viewing window above the comment section. To receive credit for your answers, you will need to register with Pigeonhole, our interactive Q&A system, by providing your name and email. Also, please remain in the default viewing window because you won't be able to see the questions if you expand the program to full screen. The course materials, which were sent out in advance, are also available for downloading under the viewing window. Now, to frame our discussion. The tax treatment of pass-throughs promises to be among the more hotly debated tax issues this year. As you probably know, pass-throughs include sole proprietorships, S corporations, partnerships, and limited liability companies. And they're called pass-throughs because their income, loss, gain, and deductions passes through to the owner's individual income tax return. That, of course, is different from a C corporation, which pays tax at the corporate level. The profits of a C corporation are also subject to tax when the corporation distributes profits to shareholders in the form of dividends. Individual shareholders pay tax on their dividends at their individual income tax rate. Now, the TCJA permanently cut the corporate tax rate from 35% to 21%. Because that made the corporate tax rate lower than the top individual income tax rate, Congress was persuaded the C corporations had a competitive advantage over pass-throughs. That's a big reason why lawmakers added Section 199 Cap A to the tax code. Now, broadly, Section 199 Cap A lets individuals, estates, and trusts with pass-through business income deduct 20% of their qualified business income from their income tax liability, subject, not surprisingly, to some limitations. The 20% deduction means that income that otherwise would be taxed at the top individual income tax rate of 37% is instead taxed at 29.6%, which brings it much closer to the 21% corporate rate. Now, Congress generally supports pass-throughs because many of them are small to mid-sized companies. Business interests are already pushing Congress hard to extend or expand Section 199 Cap A, which is one of the key provisions of the TCJA that expires at the end of this year. The National Association of Manufacturers is warning that the expiration of 199 Cap A could dramatically raise taxes on small manufacturers. And a coalition of financial services organizations is pushing for an expansion of 199 Cap A, arguing that because they are subject to the income limits under that section, they're at a competitive disadvantage with larger insurance brokers. But extending or expanding 199 Cap A will not be easy. For one thing, extending it for 10 years would cost the Treasury more than $680 billion, according to the Congressional Budget Office. For another, 199 Cap A has its critics. For example, the Center on Budget and Policy Priorities argues that the section primarily helps rich people and that it hasn't done much for the economy, and whatever economic benefits it has provided haven't trickled down to help workers who own businesses. So in the coming months, what will lawmakers do about Section 199 Cap A and about Subchapter K more generally? This will be the focus of today's conversation, and we have an outstanding panel to walk us through the issues. Manisha Santamaria is the principal in KPMG's Washington National Tax Office. She practices, among other things, federal income tax issues affecting partnerships. Steve Rosenthal is a senior fellow at the Irvin Brookings Tax Policy Center who focuses on business taxes. And Paul Shahit is a partner at Skadden who advises public and private companies on a broad range of federal income tax matters, including partnership acquisitions and dispositions. Welcome to all of you, and thank you for joining us today. So we have a lot to talk about, and let's start with Subchapter K. So a lot has been happening in the past few days. We have a budget bill that is now moving through Congress, so things are in play, and there are possible changes to Subchapter K that will be discussed. And taxpayers and advisors absolutely have to have these on their radars. Now, some of these changes are going to raise revenue, and they may be on the table as Congress looks for pay-fors to keep the individual income tax provisions in play. So, Manisha, to set the stage for us, can you first give us a little bit of an update on what's happened on the Hill in the last 24 hours? And then subsequently, maybe lead into any changes that you see to the taxation of carried interest.
Thank you, Kai, and thank you for having me. I am honored to be here today with a great group of co-panelists and Kai. It will be a fun discussion for all of us. And the discussion is timely. The train in Congress with respect to a reconciliation bill seems to be moving faster than some of us expected 24 hours ago. The House passed the budget resolution late last night, so now both the Senate and the House have budget resolutions. The Senate and House, of course, have to agree on a budget resolution. Once that process happens, the stage is set for the members to start debating what's exactly in a reconciliation bill. And it seems really, really likely that reconciliation bill might include tax in the first reconciliation bill, and any tax bill seems likely to include revenue raisers. Carried interest is a revenue raiser that is often debated and discussed and debated. Whether and when it passes the finish line is something that happens significantly less often. Carried interest legislation was passed as part of the TCJA in 2017 in the form of now current law 1061. But why is it on the table, and why are we talking about it today? First, President Trump, during a meeting earlier this month with Republican leadership, discussed including the elimination of differential tax treatments on carried interest. And he said he wanted to accomplish that in this year's tax bill. Of course, that raises questions given that there was carried interest legislation in 2017. But the tax public and members should be paying attention, and it seems likely that Republican members and their staff are thinking through possible changes to carried interest. In fact, a Democrat has introduced carried interest legislation this month. So what should people be thinking about? Well, I think people need to think about the possibility of carried interest inclusion, and Steve has very strong ideas here. I'll let him jump in for a sec with them, and then we can discuss the exact contours of what carried interest proposals might be on the table.
Sure, thanks, Manisha. First, Manisha is correct. A tax bill is moving down the tracks, both in the House and the Senate, and the House yesterday authorized the Ways and Means Committee to devote $4.5 trillion to tax cuts, net tax cuts. So this will be a big bill that encompasses an awful lot. Carried interest has been scored as relatively little in terms of a revenue raiser. There are variations out there for different approaches, but I think it's fair to say all of them have been scored relatively little. However, I think closing the carried interest loophole has a bigger impact potentially than the revenue might suggest. Because I think at this stage, a lot of the American public understand that carried interest loopholes allow investment managers to pay a lower tax rate than their secretaries. And so I think there's a lot of symbolic value for the Republicans to tackle carried interest in some form. Now, what could that form take? The first time the Republican Congress tackled carried interest in 2017, the first Trump tax bill, they enacted Code Section 1061. And 1061 extended the holding period for long-term capital gains to be passed through to investment managers. And the holding period was extended to 3 years. But it was pointed out relatively quickly that the average private equity fund holds their assets for 6 to 7 years. And so this was a swing and a miss, or at least closing a loophole for somebody who didn't want to see the loophole closed. I think when they take a second shot at it, and I think everyone acknowledges the first shot missed, they'll be more insistent. Now, they may change 3 years to 5 years or 10 years and try to tighten up some of the loopholes in existing 1061. Or alternatively, they could take an approach that's been around since 2007, a new code section 710 that would recharacterize gains from investment manager gains from investment service partnership interest as ordinary income, not capital gains. There's been variations of that proposal out, as I say, for 2 decades now. Or they could yet take a more novel approach and try to recast the financial arrangement between the limited partner investors and the general partner investment manager as a loan that requires the imputation of interest income. So there are a variety of approaches out there. And I guess, Paul, you're the most recent practitioner here. Are your clients familiar with 1061 now? And are they happy with the fact that it doesn't really work well?
Yeah, I think so. We've been living with 1061, as you said, since TCJA. I guess sort of one thought I have with the three proposals, if the idea is more of a sort of a political win rather than a budgetary win, as you say, like, does that lean more in favor of maybe updating 1061 if that's what people want to do, as opposed to trying to wholesale do a new 710 or other proposal on carried interest, if sort of going down the road of trying to figure out all new legislative language is not going to help in the budget process, and it's more just signaling that they've done something.
So I think it's really important to note the relative scores with these three proposals before we delve into what they say. I will point out that the scores attached to legislative proposals will drive the process probably more so than the actual policy calls in some of these proposals. So the old 710 proposal, which I'll call the baby bear proposal, had a revenue estimate of around 6.6 billion when scored by Treasury for Greenberg purposes recently. The mama bear proposal, the changes to 1061 that were introduced by the House Ways and Means Dems as part of the Build Back Better discussions, and particularly the Ways and Means markup of Build Back Better, was scored at raising 14.1 billion. And it's important to note that that proposal made its way into the Inflation Reduction Act, the first draft of it, to be precise. And then the Big Bear proposal is the imputed interest concept that Steve talked about, and that has a score of $63 billion. So those are different numbers. They're all relatively small numbers in the grand scheme of revenue estimates. But I do think that it is important to note that the baseline for each of these proposals is not the current law baseline. So we could see different numbers if these proposals are rescored and we see those new scores. So there are these three bills. There's, and for Congress, it's trying to do something that is more than nothing, but maybe not the most expansive. Those scores might drive decision making.
I agree with Monisha. We're talking small change for a $4.5 trillion tax bill. And I also agree with Paul that the budget process itself will make entertaining new approaches difficult. For example, former chairman, now ranking member Wyden had what I thought was one of the better approaches to impute a deemed loan from the limited partners to the investment manager. And that would address two aspects of the carried interest problem, both the conversion to the lower rate as well as the deferral. Right now, we collect too little, too late on carried interest, in my judgment. And Wyden wanted to tackle both of those. And he had more income, more revenue, according to the Joint Tax Committee, but still small. And Wyden's approach actually raises some difficult questions in light of the Moore decision as to whether imputed interest can really take hold and survive a challenge in the courts. But more generally, going from 1061 to some other approach, as Paul suggests, that may be hard in the legislative process. If you recall, the last time the Trump tax bill of 2017 was introduced November 2 and was signed by the president December 22. So a mere 50-some days enacted into law. And frankly, I thought pieces of that legislation reflected the haste. I didn't care for opportunity zones. I didn't care for 199 Cap A. Yet, a lot of the provisions have been kicking around since former Republican Chairman Campen introduced the provisions in the tax reform bill. The provisions talked about today include some extensions and include some new campaign promises by Trump. But if we start to depart from merely extending, the process really isn't amenable to much change.
But I will point out that there are a number of proposals that exist and are drafted as part of the camp discussion draft and as a part of other discussion drafts and proposals in prior bills. And for a Congress looking for revenue raisers and for a staff looking for revenue raisers, they will look at what's out there and what's drafted and what's scored. And I think it is incumbent upon taxpayers and tax professionals who care about what might be included and what might be law next year to go back and look at that draft language and make comments to the extent they see technical flaws or policy flaws or things they just think could work better or differently. Because otherwise, there'll be a bill, and once it's law, it's hard to change it.
Yeah, and is it in the scoring process, like, does it help that 1061 has been around and there's tax returns that have been filed that report income related to 1061? Does that sort of give better information on scoring for an expansion of 1061 versus these untested, unknown other provisions that have been floated out there? Does that give congressmen a better view as to what an expansion of 1061 might do?
The more data and the more precise data, I think my former colleagues at the JCT have have a better baseline to score something. So I do think more data is always helpful. I do think there has been an attempt in academia, at least over the past couple of years, to find more data about partnership income flows. And there have been some recent publications talking about the revenue and money associated with partnerships. And it's going to be interesting to see if any of that academic literature impacts scores on a go-forward basis or similar efforts
And
done in government itself.
so, Paul, I think I agree with Manisha that the experience and some of the data actually collected by the IRS from returns could yet increase the score. Although it's rare for the Joint Tax Committee to change the score much, they tend to lock themselves in. And as Monisha suggested, they often, in my view, come out with low scores when there isn't very good data. That's the way they look at things conservatively. My own view is that conservatism on a score is one of the factors why carried interest loophole has not been shut since the original hearings in 2007. And so we'll see how this process unfolds. There's been a lot more complaints about carried interest pending legislation by lobbyists and industry members and those who say the sky will fall on entrepreneurship relative to the small revenue that seems at stake. But can I shift to 199 Cap A? I mentioned some of the haste that was made with respect to legislation. And 199A, that's a pretty messy thing. Paul, what do your clients think about 199A? Have they figured it out and do they like it?
I think 199 Cap A is, in my experience, a fairly unique code section. And it sort of fulfills a lot of political goals, I believe, or supports a lot of the policy goals here. Um, it, as Kara mentioned, like it's intended to support small businesses, it's intended to support US businesses, it's intended to support job creation. We already have, I believe, like 2/3 of the senators coming out in support of, or the Republican senators coming out in support of an extension. I believe a similar percentage of the Republican Congress people coming out in support of a full extension. Um, and because it carves out like professional services firms, investment managers, asset managers, and the like. It is kind of a, Main Street focused provision. And from that perspective, I think it also supports a lot of the policy goals. I think the biggest trick here is, as Kara mentioned, it scored at nearly 700 billion, which when you think about what we're just talking about on carried interest of sort of 15 billion or so, like this is a very big um expenditure to have to offset, or to take up room in the 4.5 trillion. Um, but amongst all the things that I've heard discussed, like this has a lot of momentum.
I think it's important to note that 199A has had bipartisan support. And even if government was divided, it was likely one of the top priorities for all members. That said, when Congress is looking to extend 199A, they don't have to do it in its exact form, and they can make changes to deal with some of the budgetary constraints.
I guess that's the big question is, if it sticks around, is it going to be modified and what would that modification look like?
And where I think we expanded or contracted or both. And I think like all these things are things that taxpayers and tax advisors should be watching for as we go forward um, into a very interesting year.
I think it goes to like what is the role of 199 Cap A? Like as originally conceived, it was I believe like intended to support smaller businesses that have significant employment, etc. Um, if it's going to take on a broader role of general kind of reduction in taxes for U.S. businesses, like, yeah, I guess we could see an expansion of it. Maybe, as I said, like now is kind of limited depending upon type of industry. There's also restrictions based on income amounts, et cetera. Like you could see loosening of those if the goal is a more broad lowering of tax rates on U.S. businesses held through flow throughs. As you said, like the U.S. businesses that are taxed in corporate form already got their permanent tax rate reduction, and this is in essence a way to give a long-term or permanent tax rate reduction for the other businesses.
Paul, I think you give too much stock to the purported reason for Code Section 199 Cap A. Corporate tax rates were being reduced from 35 to 21% in 2017. And those in pass-through businesses, they wanted some too. As long as taxes are being cut, you get a tax cut, you get a tax cut. They leaped on board. And it turns out that in practice, not only is this very expensive, this $700 billion provision, but the distribution is really it really is ghastly. The top 1% of taxpayers derive more than 50% of the benefit. There are a lot of millionaires who are squeezing in under the notion of small. And there really is no size limitation of small in terms of number of employees or the like. Uh, Mainly, this provision's got a nice name. It sort of captures the notion that there's a small business provision on the theory that a lot of small businesses are organized as pass-throughs. But it turns out the bulk of the benefit goes to very rich individuals, as well as some of the very largest uh, 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 businesses in America. Now, I think that there's been a bipartisan interest in trying to give some benefit to small business, especially when publicly traded companies receive the windfall from the corporate tax cut rates. But it's really hard to craft a provision that helps small business, hard to in a sensible fashion. And you could do a variety of things. You could shift the deduction to a credit because deductions are more valuable to highest income taxpayers. You could use a cost-based incentive rather than an income-based incentive, like giving some incentives to invest more or hire workers. Or you can shift to sort of more neutrality, a broader reorganization of our business taxes, trying to get corporate integration and having one uniform, rational regime. But again, all of those will take a while to get done. And I don't think there's a lot of appetite to doing anything other than extending this provision for many more years. And I would say if you read some of the critiques uniformly from policy analysts and academics, this goes down as one of the worst provisions ever to be enacted by US Congress, maybe rivaled by the opportunity zones, in my judgment. But I don't care for it, in case you can't tell.
I'm going to interject an audience question here because it relates to 199A. The question is, how would taxing partnerships at the entity level affect the calculation of Section 198 deduction in complex tiered partnership structures? Does anyone want to take a go at that?
Well, I sort of hinted about trying to create a unified tax regime for different business forms, neutrality. And one approach would be to tax partnerships, as corporations, and tax corporations and subject them to just one level of tax. Say, some people suggest having pass-throughs tax as corporations only if they're very large, but that would complicate the code even further, having so many different regimes for different types of forms and different sizes and the like. But that's a really hard thing to do, to create one business entity. In part, if you look closely at the tax structure for publicly traded corporations, uh, there are a lot of not-for-profit shareholders and foreign shareholders, so that when a corporation pays a lower tax rate and the shareholders pay zero, we're not really collecting much. And if we tried to shift to a unified regime to collect taxes from one level, then we'd have to either increase the entity level tax or start taxing tax exempt owners in order to be revenue neutral. That turns out to be a large problem politically. Chairman Hatch wanted to pursue in 2015 a corporate integration regime along the lines we're discussing now. And he ran into the political problem of how is he going to start taxing retirement plans and not-for-profits in order to be revenue neutral.
But I think it's really, really important to note that this idea of a unified regime for all business entities or unified pass-through regime has been explored many, many times before. And once people spend enough time exploring it, it's generally rejected based on the huge technical concerns that are presented and along with significant policy concerns. For example, in the early 2000s, JCT spent a few years exploring the proposal and then issued a report in which they talked about the administrative revenue and equity concerns with respect to making such a change. And it said that they couldn't endorse any unified pass-through regime as a result. So it's really important to note that while it sounds good and is at some base level appealing, it raises so many concerns and probably will lead to inequities in the tax code that are just different and possibly even greater than today's.
Interesting. So let's move on from 199 Cap A because we've got a few other topics we want to get to. But what do you think Congress will do with respect to the excess loss limitations in Section 461L?
So, first of all, current law 461L is only set to expire in 2029, not in 2025, as with respect to other tax cut and job provisions. But to level set, current law 261L creates a business loss limitation deduction for pass-through entity owners. Basically, an owner of a pass-through entity can't deduct more than 500,000 with respect to business losses in a single year. In the second year, that amount is tested under the NOL rules. So basically, it is a 1-year deferral of business losses under 461L itself. 461L, I think, is most interesting in terms of the political lessons it teaches. It was passed as part of TCJA, as part of a Republican reconciliation bill. It was extended as part of the Inflation Reduction Act in a Democratic reconciliation bill. So it teaches us that one idea that raises revenue can be used both sides of the aisle, basically because of the revenue raising impact. So that's my 461L takeaway.
Well, I would be a little more blunt, Manisha. I think 461L is largely a budget gimmick. It just deferred within the window some revenue that would otherwise be collected or accelerated, otherwise revenue from income that otherwise would be deferred. And the losses that are deferred are one and done. That is, the loss is converted to a net operating loss the subsequent year and typically can be taken. And there are some proposals to tighten the one and done rule and make the 461L have a bigger bite by Democrats. But I don't think Republicans are going to buy that.
No, it was proposed as part of Build Back Better to make it a permanent limitation, so that if tested in 1 year, that amount would be carried over to the next year and tested under the 500K inflation adjusted limit. However, the revenue scores, if I recall correctly, with the one and done version versus the permanent version weren't that different.
I would add, for those who might want to see something here, that I think that there is a budget gimmick aspect. It's been extended a couple of times, not very binding or effective, but it raises revenue from high income taxpayers. And I think the Republican tax plan's largest vulnerability going forward is the distribution tables that Monisha and my former office, the Joint Committee on Taxation, puts out. And I think that the Republicans were somewhat scarred with the first tax bill as being relief for billionaires and corporations. And they might like to tackle or at least forestall some tax cuts for the highest income just to get better looking distribution tables. My old office, I've actually semi-retired last month from the Tax Policy Center. One of my colleagues, Joe Rosenberg, put out a nice distribution table for what would happen if the top rate was left at 39.6 will return in 2026, and all the other top rates will stay down, but the 37% top rate for the highest income would go up to 39.6 again. That would make distribution tables look a lot better, and there'd be a lot of revenue that could yet be raised. And so I actually think that's a possibility, not just there, but across the board, especially with budget gimmicks, to look as if there's more taxes being collected from high income.
Interesting. Steve, let's keep going, and I'm going to ask you another question on net. So, what are the implications for pass-throughs if net investment income tax expands to include non-passive business income?
Well, Carrie, you know that there's been a lot of argument over what income is subject to employment taxes, what income is subject to the net investment income tax, and there are a lot of gaps. In 2017, actually this was before this was an Obama era change in 2010, 2012, that created a lot of gaps for the net investment income. So you have income tax, you have general partners and sole proprietors who pay SECA, you have S corporations that sometimes pay SECA, sometimes not, depending on whether they label their distributions as a reasonable compensation or not. You have limited partners and some LLCs who pay no SECA. And then you've got the net investment income tax that sometimes applies and sometimes doesn't. And every Democratic administration, from the time that these gaps were created, the Obama and Biden administrations have tried to rationalize those systems. There hasn't been any progress. Now, there has been some recent attention to these gaps because Treasury Secretary Bessent, at his confirmation, acknowledged that he exploited one of these loopholes. He was a limited partner in a hedge fund that he founded that was called, what was it? Something Square, Corner Square, Key Square Group. And he took the position that the income that he drew from his hedge fund was neither subject to the payroll taxes, employment taxes, nor subject to 1411, the net investment income tax, because A, he was a limited partner, and B, he's got a loophole under 1411 because he meritorially participated in the hedge fund's business. Seems sort of contradictory, and the issue is being fought out in the courts. But how this will end up, I don't know. There's been a lot of attention. That would be real tax reform to try to rationalize that. And maybe Secretary Bessent, who's all over this issue because he was asked about it a lot, maybe, yeah, he could tackle it. I would add, as an aside, given the budget cuts to the IRS enforcement budget and the firing of agents, it sure would be nice to rationalize some of the rules to make it less challenging for the IRS to administer tax rules and to litigate factual questions as to valuations and material participations, and then litigation, the law. It sure would be nice to streamline some tax rules in order to help save some enforcement efforts by the IRS. That would be good tax reform, and I don't know whether it'll happen or not.
That sounds like simplification, and I question whether we will ever really get there. Manisha and Paul, I'll open it up to you before we turn it on. We've got kind of a big topic coming up. So, any thoughts that you had on net investment income tax?
I mean, to Steve's point, like, I think we just introduced like a third category. Like we had talked previously about measures that have political aspects to them, and then measures that have budgetary benefits to them. It sounds like, Steve, there's a third category of things that would make the tax system more rational, as you say. Would you think that this provision also falls into the political or budgetary buckets, or this is just more of like there's a series of provisions out there that maybe would make the tax system better from a normative perspective, and those and if so, like, do those have any possibility of getting through in a TCJA 2.0, or are we really limited to like the political and budgetary ones?
Well, this one raises a significant amount of money as scored in for Build Back Better purposes. It was scored as raising over 200 billion, if I remember correctly. And that was with a carve out for anybody making less than $400,000. So there's money to be had, and there is a way to say that lower and middle income taxpayers are not hit by this change, which provides some political talking cover, influencing cover for a change like this. That said, it is tied to a Democratic bill, so we can query how that plays in the current landscape.
So, Paul, I worked for the Joint Tax Committee in the 90s and met with a lot of lobbyists and constituencies. And there's a constituency for every loophole in the tax code, but no constituency for simplification. That's the staff that tries to get the members of Congress to listen to their better angels. That happens sometimes, but I guess I would hold my breath. What do you think, Manisha?
I think it's always hard to do something that makes too much sense. And I think this one has been an idea that's floated around for a long time. So I think it's possible. And I think the fact that it has a sizable score increases that chance. Um, I also think taxpayers and members of Congress and the staff should think about the current court cases and whether the revenue to be had now might be greater than revenue to be had in the future if the court cases end up taxpayer adverse, which is a big if.
I think it's always hard to you get to simplification, it sounds great, but it's hard to make that change in practice, and then because you always end up having to try to solve problems that you didn't know were there, and before you know it, you're back to something that is as complicated as it once was.
And I will point out, and this is my high horse, that ideas that sound simple are often too simple to be good and to be actually simple. And I think a unified pass-through system is like the prime candidate of it sounds great, it sounds simple, but once you get into the details, you run into so many policy and technical hurdles. And the biggest one is that you might be divorcing tax from economics, which is no good for the tax code, both from the FIS perspective and the taxpayer perspective.
That's a very, very good point. Misha, let's move on to related parties because this will be kind of a big conversation for us. What potential changes do you think could be made to the rules regarding related parties?
Well, let me start with the fact that with the one that is in the press, and that is related party basis shifting. Treasury in the outgoing at the end of the Biden era put forth some guidance on related party basis shifting, including final rights that addressed the transaction of interest. And there was a lot of press around related party basis shifting. And most notably, there was a lot of talk about the dollar amounts associated with related party basis shifting and the impact of regulatory and sub-regulatory changes. Those changes were first reported to raise $50 billion and then $100 billion. So members of Congress and their staff might just see dollar signs. And given that fishing for dollars and couch cushions is part of what's happening now, I think related party based shifting through legislative action is something that taxpayers and tax advisors should be watching. And that's point number one. And I know others may hear reactions. I do have to second it after that. Let my esteemed co-panelists react first.
Yeah, I was wondering about that, and I think you guys know better than I do. But like, if because the revenue ruling and the notice came out last year and kind of already said that certain transactions have kind of new tax consequences. Does that mean that like if that were to be codified, that could result in a scoring, or is it like that? No, that income has already been captured in a way because of the notice and revenue ruling, and so codifying it doesn't create any budgetary advantage. I was wondering how that works.
Well, I think we're in a weird state of play. The only thing that is in final red form is a transaction of interest notice, and that's reporting, mainly. It is reporting that might encourage or discourage some behaviors, but that's reporting. It is clear that Congress could address basis and related party basis shifting legislatively. They have the pen, and they could take the same approach that was set out in the notice that announced substantive proposed regs, or they could take an entirely different approach. My guess it would be easier to, from just a drafting perspective, to do something different. But they could also do something similar based on the fact that that idea has been developed. So it is the differential between what taxpayers are doing now based on just a transaction of interest final regs and behavioral impacts to sub-regulatory guidance and whatever the congressional idea is that would impact this forum. And I do think the fact that there are numbers associated with the sub-regulatory and regulatory actions, just in terms of enforcement, might impact total score.
So yeah, I think Manisha describes how our old employer, the Joint Committee on Taxation, scores tax legislation. They look at the baseline, how much revenue will be brought in from a proposed change. And if taxpayers were all lining up to comply with the Biden proposed reg regime and the Biden reporting regime, then there might not be too much revenue. However, as Monisha points out, the only final regs that are out there is with respect to the reporting regime. The IRS has lost a lot of the agents that might enforce the law here. The finalization of the proposed basis shifting may not ever occur given the change in administration. And from a baseline standpoint, I think this would be a change, even if it were the same change as proposed by Biden, would be scored as a big revenue raiser by the Joint Committee on Taxation by Congress. because I think it would change the baseline and taxpayers' expectations. Among other things, let me just highlight, uh, for those of you who pay attention to the courts, the Loper-Bright decision, which in effect overruled the Chevron doctrine of deference to an administrative agency, it's not clear that the Biden proposed regs, if finalized, the substantive regs with respect to basis shifting would hold up. And so that's all the more reason for A, Congress to act to create certainty, and B, for Congress to claim the revenue. I think there's revenue here if Congress wants to take it. And the Biden administration certainly signaled a lot of revenue. I think they doubled the revenue estimate from their proposal when they first opposed gathering information, because they started learning more and more about these transactions. And I think they raised, doubled the tens of billions, like 60 to 120 or 80 to 160 billion.
50 to 100. If I have my number. Yeah.
Okay, thank you.
But I do think it is important to note that there are ideas or perceived problems that could be addressed legislatively or through congressional action. And when Congress addresses them, that's where how you get a score a number on a revenue table for a reconciliation legislation. And I think that is an important point to keep in mind. And it doesn't even matter which branch of government is better from a policy standpoint and in addressing a problem. That revenue table is going to drive a lot of what we see over the upcoming year. And taxpayers and tax advisors who are generally focused on the policy and the technical need to keep that political reality in the back of their minds as we move forward through the next year. Steve also brings up a point about Loper-Bright. And I think Loper-Bright might provide an argument for Congress to do something in the sub-K space. Sub-K, as it exists today, in some cases, or the partnership tax rules, is pretty short compared to other areas of the code, and it's very principle-based. Congress thinking about what Loper challenges could possibly come might feel the need to expand on some of the first principle-based language in subchapter K, just as a way to protect the fifth's interest and to provide taxpayers with much desired certainty or certainty in the eyes of Congress. So it creates an interesting dynamic, an in wrinkle in this very unusual political time.
Very good point. Paul, I want to ask you a question on reporting. We had talked about this before, and a lot of what we hear when we talk about, there's just more reporting. And so the partnerships are continuously having to do new reporting, fill out a new form, give more information. When is additional reporting from partnerships just simply too much? And what are you hearing from your clients as well?
Yeah, I mean, you're right. We've certainly seen like more and more information reporting in the past several years. In addition to issuing K1s partnership to its partners, partnerships now have to issue K2s and K3s sometimes. Plus, I think the K1s now even ask for more information than they used to. And this is all in addition to, as what we were just talking about, more potential, transaction of interest reporting on basis shifting, which was a thing that was defined pretty broadly in those regulations. There's new kinds of 1099s seemingly every year. So that being said, like I understand the benefits of information reporting as a means of policing compliance. But you sort of wonder at some point whether there's diminishing marginal returns. In other words, like there's some level of information reporting that helps ensure that taxpayers are in line with their filing obligations. But I imagine that at some point there's so much information that's being collected and required to be submitted that the compliance burden and the risk of a foot fault by a taxpayer or partnership might begin to outweigh the usefulness of the information that's being collected. I suppose we might have soon seen kind of where all that information was heading, given the change to the partnership audit rules that happened a few years ago in connection with what had been kind of a staffing up at the IRS to look at partnerships. And I assumed that all the information that was being submitted was going to um, sort of give agents a head start on looking at what they might want to ask questions about in partnerships. But I do think that at some point, like, there's so much data and specificity of data that's being collected that it's can be a burden on businesses, particularly smaller businesses. It's almost like, in addition to all the other officers you have, you need like a chief tax reporting officer to do all the tax reporting that needs to get done every year. So I don't I don't know when that sort of scale tips in terms of there's sort of too much data that's required to be submitted now, but it does seem like it's much more and more every year that I'm not really sure where it's going.
And I will take my turn to be really blunt here. I think the amount of partnership information reporting is hurting both taxpayers and the FIS at this point of time. I think when the forms ask for so much information, some are really important, some are less important, and taxpayers who are trying to comply just can't do it all right and completely. You make filling out forms well optional, and that doesn't help taxpayers and it doesn't help the FIS. It's garbage in, garbage out to some degree. And, if there was time and space to have a discussion about, changes that everybody could agree upon, I think rationalizing partnership reporting to focus on what's actually useful for everybody and what's actually doable would be a great discussion to have.
Well, let me take a different position than the two of you. I have no clients, so I am less client sympathetic here. I think about how will the U.S. government collect the revenue that it needs to provide the services that we all demand. And there are two approaches to getting people to pay the amounts that they owe, which will be used to pay for the services that we all demand. One approach is to increase the penalties if you fail to make the right payments and the like. And that raises a whole bunch of different sets of problems. The other approach is to increase the likelihood of being caught if you pay less than you're legally obligated to pay. And to increase the chances of being caught, you need to put more agents on the street or make existing agents more productive and effective. As you can tell from this administration's early start, they're cutting agents on the street. And so, how will the remaining agents be more effective? Well, I think they'll have to lean more on information reporting. And so, I think voluntary information from taxpayers, book tax differences, expanding some of those requirements for partnerships like we do for large corporations, apart from information reporting on basis shifting like the Biden administration wanted to collect. I think that'll be a more important tool if we're taking agents off the street.
And I think good information helps the FIS. I think more information isn't always good information. And I think is a discussion to be had there.
Yeah, I would have to agree with Manisha. There has to be a point where too much is simply too much. As my husband and I had a small business, and I can tell you that it was really, really hard, even in the small little world we were living in. It's really, really hard to try to make sure that you're complying. And I work at tax analyst, so I was really concerned about making sure that everything was right and proper, and it was a challenge. I want to jump to an audience question in our final few minutes because I think it's an interesting one that I had not posed to you guys in advance. What is the likelihood that the SALT workarounds by the states will get restricted?
So there was an article in Bloomberg this morning, not Tax Notes, but Bloomberg, that was really good, explaining some of the ideas on the table and the budgetary impacts of doing something with the SALT workaround. I think to level set, there is a cap on the amount individuals can deduct for state as part of state and local taxes. That cap is set by the TCJA. It's $10,000. The same limit applies to individuals, whether they're married filing jointly or not. Extending this limit is really expensive. Upping the limit is expensive. Upping the limit from 10,000 to 30,000 was projected by outside sources to cost $500 billion. Congress certain members of Congress have a strong desire to up this limit. There was a pass-through tax entity workaround that was blessed in a notice during Trump's first administration. It helps owners of pass-through entities not deduct more than that $10,000 amount, to put it really bluntly. There are reports that closing the pass-through tax entity workaround would raise $180 billion, so you get some of the way with respect to paying for an increase in the individual limit overall, which might have political appeal. There's a related idea out there known as sea salt that would limit the deduction for state and local taxes for C corporations too. That change is, for outside sources, is supposed to it would probably maybe raise over $200 billion. And unclear if there's overlap between that $180 billion number and $220 billion number, but you could see these ideas being at play as SALT gets discussed often in the coming months.
Manisha, how do those numbers compare, those revenue raising numbers with respect to closing the workarounds, compared to the revenue losing measures from increasing from, say, 10,000 to 20,000 or some higher number?
So
Congress package the two together in a revenue neutral fashion and solve the SALT workaround and SALT limitation problem?
if they play with the numbers long enough, yes. And that is definitely playing with the numbers to get to the number you want is definitely part of the legislative process.
Interesting. All right, go ahead, Manisha.
I'll just stress that there are tax policy discussions to be had, and then there are more practical discussions to be had about the budgetary impacts of different proposals and getting a bill together and across the finish line. And pass through taxation, and there are lots of really good policy questions to be had, and even policy questions about whether it makes sense to change most parts of it. That question might be secondary to the need for revenue in this very unusual year with $4.5 trillion on the table, as Steve started out us off with.
Yeah, I always assumed they would get rid of the SALT workaround and then increase the cap. That seemed like something that was relatively low hanging, although I guess it does those people that are in high tax states, or I suppose it's the wealthy that have the pass-throughs, that have the workarounds, that are making donations to both sides. So it necessarily gets political.
I also will point out that we have not seen legislated language addressing the SALT workaround, and from a technical standpoint, I think it's not easy to grasp.
Interesting. That's a very good point. That's very interesting. Well, let's get to one last question before we close out. One last audience question. Are you seeing any support for changing 163J from EBIT to EBITDA?
I think that's on the table and strongly on the table.
Interesting. Anyone else?
Yeah, I have seen that. I think maybe the policy angle to it is it's supportive of businesses that have CapEx, spending money to invest in machinery, et cetera, in the US. So from that angle, like, it has political appeal, and I have heard people talking about extending that or reinstating it, I guess is the real way to say it.
My sense is all of the corporate tax raisers expanding the base in 2017 are now subject to renegotiation. And so we'll see where this tax bill ends up. Ironically, going back to where we started, one of the justifications for the 20% pass-through deduction was that as the base was expanded for businesses, limiting R&D expense write-offs, limiting expensing of capital investments, that it wasn't fair for pass-through entities to have to pay tax on a larger base without a lower rate like corporations have. But if we're going to reverse all the base broadening that occurred in 2017, maybe the original argument for lowering taxes on pass-throughs can now be diminished and written off. I don't have a lot of hope for that, but it does seem as if that would be consistent.
It's a very good point. It does seem like it would be consistent. Well, this takes us to the end of our time. I want to thank all three of you for joining us today, for offering your thoughts and your opinions and your knowledge. It was very, very helpful, and I am sure the audience enjoyed it as much as I did. So thank you all for joining us today, and I look forward to the next one.